Hi, class, and welcome to Chapter 8. Chapter 8 will get into Introduction to Bonds. Bonds basically is a debt instrument that provides a periodic stream of interest payments to investors while repaying the borrower or the borrowed principal on a specific maturity date. And bonds are supposed to be pretty solid. Years upon years ago, when we were in World War I and World War II, bonds were created to offset the expense of running a war. And if it's a government bond, which 90% of them are not government bonds, you're in pretty good shape if you actually invest in the bonds. Bond terminology. In terms of what actually is understood about a bond, you'd go with the par, which is the face value of the bond. The price of the bond when first issued. The very first time it's purchased is considered the par, often in multiples of thousands. More bond terminology is the coupon rate. Everyone thinks, what does the coupon rate mean? Well, this is the periodic interest payments promised to bondholders. They are a fixed percentage of the bond's face value or the par. This percentage is known as the coupon rate. Something important you might want to know when you're actually investing in bonds. So coupon, the dollar value of the periodic interest promised to bondholders. We covered that. Maturity. What actually does the word maturity mean when it comes to bonds? Well, it actually is a time until the principal is scheduled to be repaid. The maturity date of the bond. When is it completely repaid? When you can call a bond is called call provisions. Call provisions basically are on some bonds which contain a provision that enables the issuer to buy the bond back from the bondholder at a prescribed or a specified period prior to the maturity date, not before it's at maturity. A bond containing such a provision is said to be callable. You hear that all the time. Is that a callable bond? That's what it means. This call option is known as an embedded option since it can't be bought or sold separately from the bond itself. Put provisions. A put provision basically is some bonds contain a provision that enables the buyer to sell the bond back to the issuer at a pre-specified price prior to maturity date. Convertible bonds are pretty cool. A convertible bonds contains an embedded option. The holder has the right to convert the bond into a predetermined number of shared stocks. Bond issuer. The bond can be categorized according to their issuer. We got the treasury bonds, corporate bonds, municipal bonds, and foreign bonds. So let's talk about treasury bonds. Treasury bonds are issued by the U.S. government to finance its deficits, which means its debts. They need money in order to pay other folks that they actually are in debt to, like China, Japan, Brazil, and so forth. These are free of default risk, which is the risk that most investors will incur when they receive promised payments. But these are considered free of default risk, I should say. They're also not taxed by the state and local governments. Double check on that. Corporate bonds. Of course, corporate bonds can be raising funds by issuing debts in the form of corporate bonds. These bonds offer a higher promised coupon rate than treasuries, but expose investors to default risk. These are corporate bonds, not the actual bonds we spoke of earlier, which are government issued bonds by the United States government. Rating agencies such as Standards and Poor's and Moody's rank corporate issuers according to their likelihood of default. So you want some really good ratings when it comes to actually getting into corporate bonds. Do your research. You could look into Morningstar, which shows all of the bonds that are publicly traded through corporations, and take a minute to determine whether this corporation's bond is right for your portfolio. The riskiest corporate offers the highest coupon rates to investors as compensation for the default risk. So you get more money for your bang, but you may end up having a bond that is no longer valuable. Municipal bonds are my favorite. Municipal bonds basically are bonds issued by a state or local government. As a result, they carry little to no default risk. That's something I like to always hear. They also offer an extremely favorable tax treatment to investors, which means some states don't charge any taxes on municipal bonds. So your next question is, well, can you get them from other states? Yes, you can. Not just California or not just Los Angeles and so forth. You can get them from Miami, Missouri, and so forth. A municipal bond is not taxed by the federal level. It is also not taxed by the issuing municipality. As a result, municipal bonds offer very low coupon rates to investors. So you have to see what that balance is. Do you want a high coupon rate so you can get money back? Or do you want to have it more where it's no default? Municipal bonds, no tax consequences, municipal bonds. Foreign bonds are a little bit different. Foreign bonds are issued by foreign governments and corporations. These may be denominated in dollars or in a foreign currency. Something to keep in mind. So, for example, suppose that a bond is issued with a face value of $1,000, a coupon rate of 4%, with a maturity of 4 years. So here's the math. With the face value of 1,000, the bond will make an annual coupon rate of about $40. That's pretty good. 4% of 1,000 is $40. So within that given year, you're going to see $40 additional to the $1,000 you've already invested. Pricing bonds. A bond's price equals the present value of its expected future cash flow. Good example is referring to the previous example. Suppose that appropriate discount rate for the bond is 4%. What is the price of the bond? Well, if we go over here, we'll say a bond that sells for less than its face value is known as a discount bond. It's a discounted bond. A bond that sells for more than its face value is known as a premium bond. Zero coupon bonds, a zero coupon bond does not make any coupon payments. Instead, it is sold to investors as a discount from face value. A difference between the price paid for the bond and the price or the face value represents the return, I should say, to the investor. This is also known as capital gains. So capital gains tax comes into play.